Here's a quick question for you. What was all that fuss about GameStop? You may have noticed at the beginning of the year, everyone was suddenly talking about GameStop.
GameStop.
You may have even had someone in your orbit tell you that you had to use as much of your savings as possible to buy up their stock. And if you're anything like me, your response was, LOL, what savings? Point is, seemingly overnight, this blockbuster in video game drag went from a store you haven't set foot in since Obama was president to the hottest ticket on the stock market. And they did it without changing anything major about how they do business, which goes against all conventional wisdom. But again, if you're anything like me, you barely know the conventional wisdom, if at all. So let's break it down. Say you have a medium-sized chain of successful video game stores, and you're looking to take it to the next level and go national. You could then make a pitch to investors about your vision and why you belong in every strip mall in America. And if you can convince investors to buy into your vision, you can sell them a piece of your company. That piece is called a share of stock. You can then take that money you made from the sale and use it to buy and rent property, hire employees, purchase equipment, pay off debts, all the different expenses you incur while trying to grow a company. And as your business grows, it will become more valuable, which will make each stock worth more money. But if you want your stock to be worth real money, you can't just sell it by yourself. You need to do it on an exchange where people can buy and sell multiple types of stocks and assets. To do that, you'll need to conduct what's called an IPO or an initial public offering. It's like a coming out party meets the show Shark Tank, where you bust open the doors and say, hey guys, I'm offering up this much of my company at this price per share, who wants some? The hope is that enough people will want a piece of you, literally, that it drives your share price up. And that's what happened to GameStop, all the way back in 2002, back when we still needed discs in order to play video games. So then why are they making such big waves almost 20 years later? That story illustrates a few things about today's stock market that are not so great. First, you can only invest in stocks to build wealth if you already have money to invest. If you're part of the more than half of Americans who are living paycheck to paycheck, you can kiss this opportunity goodbye. This might explain why around 85% of last year's stock market profits went to just 10% of American households. The more you can afford to invest, the more you stand to gain. Also, it's possible to make money from a stock even when it goes down. This is called short selling or shorting for, well, short. And you may recognize it from the 2015 film, The Big Short. When you short a stock, you're basically borrowing it so you can turn around and sell it yourself. Then, if and when the stock goes down, you can buy that share back at a lower price or cover it and pocket the difference. Now, chances are that the average investor will never get to try this. 1, you need a special type of investment account to even do it. 2, it's incredibly risky. But shorting is a frequent tactic used by hedge funds, which are just groups of wealthy investors that pool lots of money together and use it to their advantage to make even more money. And while they tend to be good at what they do, they can also make stupid mistakes. In January of this year, some users of the subreddit Wall Street Bets noticed that hedge funds and other financial bigwigs had shorted more shares in companies like GameStop than actually existed. In other words, they were so confident that the share price of GameStop would go down, they short sold about 140% of the company, kind of like in The Producers.
Under the right circumstances, a producer could make more money with a flop than he could with a hit.
You bloody little genius!
The Redditors then figured out that if enough of them bought stock in GameStop at once, they could drive the share price up and trigger what's called a short squeeze. In other words, a lot of those hedge funds would see the prices rising and then try to buy up shares to cover their position. This would drive the share price even higher. And remember, the big wigs had shorted more stock than actually existed. So, the race to cover their position was a stock market equivalent of musical chairs. Except if you were left standing after the music stopped, you could lose a theoretically unlimited amount of money. And boy, did it work. These rogue everyman investors managed to drive up the value of GameStop 30 times what it was previously. And then they replicated that formula with other waning companies like AMC, BlackBerry, Express, Fossil, and more. They were making money while hedge funds lost at least an estimated $6 billion and at least one had to shut down. So in short, everyday investors took on Wall Street and won. Happy ending, right? Wrong. Because shortly after the squeeze was triggered, retail investing apps like Robinhood began blocking people from purchasing shares in any of the affected companies. And some users even allege that the app sold shares without their consent. By the beginning of February, shares in all of the affected companies dove back down again, partially because investment apps were preventing users from buying them. Those who bought in closer to the peak ended up losing money. And now there are at least 34 separate class action lawsuits against Robinhood and other online trading apps, alleging that their restrictions sought to manipulate the market on purpose and protect the interests of their high-profile friends. Congress even held multiple hearings about the whole debacle, although no significant legislation has passed as a result. On the bright side though, GameStop stock is currently sitting at around 5 times the price it was at the beginning of the year. But unless you're one of the lucky few who got in early, this whole fiasco is really just proof that Wall Street desperately needs regulation that can keep it in check. Since that's not happening for a while, here's something else for you to do.
If there's any topic out there that's got you scratching your head and you're too scared to ask, you should totally send it our way. Tweet using the hashtag #QuickQuestion, or email us at questions@brainjoltmedia.com. Don't forget to follow us, and remember, quick questions don't always have quick answers.